loan market, the commercial loan market in the United States, and maybe we'll touch on few other aspects of the real estate market. I'll start out with the intros. I'll go first. My name is Zach Alerhand. I work at Time Equities as an investment strategist, where I am part of the process of procuring our development properties, in addition to strategizing behind which and when we're going to be financing properties, in addition to overseeing the acquisition review process that we do while all of our deals are in due diligence. So I'll be hosting today, and I'll let the other two, Abe and Justin, introduce themselves. Abe, you want to go first?
Sure. So my name is Abe Hannigan. I work with Berkadia Commercial Mortgage. We're based in Midtown Manhattan. I'm a director with the Originations Group. We're a direct lender on multifamily. So we do company-wide about $26 billion in loan volume every year. The New York City office is responsible for about $2 billion of that. About 80 to 90% is Fannie Mae and Freddie Mac loans. So tons of multifamily, and we will also structure debt and equity on behalf of our existing clients that may not be a multifamily project. So while we do focus on multifamily, we do touch every asset class.
Thank you, Abe. Justin?
Yep. My name is Justin Piasecki. Managing partner at LEV Capital, which is a tech-oriented real estate investment banking firm in New York City. I focus on three different sectors. First is raising capital, so LP equity, co-GP equity, mezz, pref, and first mortgage financing for investors and developers around the US. Secondly, I trade and sell performing and non-performing loans for banks and funds. And my third line of business, I raise lines of credit for different family offices and private equity funds that are in the bridge lending or in the loan buying space.
Great, thank you so much. And I realized I forgot to mention, I'm just going to add about Time Equities. I'm sure many of you may not be familiar. We're an owner, operator, and developer. We own, around 35 million square feet around the US and internationally. And we touch on all asset classes. But with that, I'm going to jump into some questions, and we're going to do this in an open format. So Abe, Justin, feel free to, answer whichever you feel you have expertise in. And after we get through a few, we'll leave the last 10 or 15 minutes for a Q&A from the audience. So just to get started. So the commercial financing market was certainly affected by COVID, as were all other aspects of the industry. Can either of you talk about the US financing market in the depths of COVID and where we are in the recovery today?
Yeah, I guess I can go first. I guess the financing, last end of March, April, May, definitely kind of grinded to a halt when everyone was trying to figure out what exactly what the situation was. A lot of the private equity funds and debt funds, frankly, had a lot of issues because they had margin and capital calls at that point in time. And so they definitely, for most part, they weren't lending. We did a couple of deals in April, May, and June of last year with debt funds. But in the acquisition market grinded to a halt because nobody wanted to buy hotels or multifamily or anything. That being said, the financing, I would say, was there and opened up. We ended up doing a lot of recapitalizations and refinances because you have a maturity that on a property was coming due. Lenders, they were understanding, but they weren't. And so ended up, for me personally, had a decent, I would call it April through December. I did 6 deals that were north of $100 million check sizes. And then we did probably another 35 deals that were, just, normal size deals. That being said, a bunch of that business actually came to us because investors and developers, their go-to lenders or go-to equity sources were on the sidelines. So it was interesting. There was a lot of fear, but I also went through the last 2009, 2010, and 11, and my business we morph. When bad things happen, sometimes it's good for us because we're flexible. But that's just my background and opinion on what had happened.
Right. I mean, I'd really echo that. The February, March financing market really did slow down. Everyone was kind of wait and see what was happening, and then even though while it did slow down, rates remained extremely low. So while there's volatility, there's opportunity. So I agree on the acquisition in front, it really came to a halt. But on by the end of the year, with almost 2-3 months cut out of financing opportunity, we were still able to have a record year because there was so much refinance activity with rates hitting historic lows. Everyone kind of either, if they didn't refinance, they wanted to see what they could refinance for. So at the beginning of 2021, we've seen rates come back up. And while things are starting to stabilize, people are looking back and thinking, oh, maybe I should have took advantage when rates were sub 3% on 10-year money, which now it's just not the same conversation anymore.
Would you guys say, I guess, if 1 is, the worst part of the market in COVID, and 10 is, full on recovery to pre-COVID levels, if you could say we're going to get to that point again, where are we on that scale?
I mean, I think it depends on the asset class, right? And the location. Yep. I think we all see South Florida and Texas and the Nashvilles have been booming for 8 months, 8 months plus. New York is starting to recover. I think we're all work in New York City, and we see the traffic picking back up, and restaurants are full and bars are full. And I know in my office, everybody's been in the office since January. I commute from New Jersey down by the Jersey Shore to New York City, and my ferry every week is picking up with more and more people. And I was just in Los Angeles about 2 weeks ago, and I think they're probably furthest behind everybody out in California. But they're, went out to restaurants and had meetings with people, and some of the people said I was their first meeting in person in over a year. So I would say, depending on location, but all across the US, we're probably at a 7-ish on getting back to some stability and normalcy.
Okay.
Yeah, I would agree. I'd say New York City, everyone thought New York City was dead and gone, and everyone was going to move out and never come back, but we've sort of seen a resurgence very quickly and steadily. And I would also say in terms of the COVID recovery, a lot of lenders sort of became risk adjusted with COVID reserves and escrowing for principal and interest for a certain amount of time in the first year of the loan. So you can sort of see lenders scale back on those COVID requirements really over the past couple of weeks. It seems almost every week they'll say, oh, well, now on certain deals, we won't require a COVID reserve, or we can release the COVID reserve early on this deal. So it's almost a matter of time until they're sort of gone completely.
Great, thank you guys. And I think a little bit later we should talk more about the differences in closing a deal now that COVID has had its effect on everything. And just I'll add, one other aspect that you brought up in New York City. It's interesting. Somebody told me a statistic that about 70% of the people who were leaving New York were in one way leaving many of their items by keeping the apartment here or leasing a storage unit. And, the storage units in New York are not cheap. It's maybe $800 to $1,000 a month. So, they took that as a telltale sign that people are eventually going to come back. And I think we've been seeing that so far. But just to move on. So did you see a lot of distressed loan sales in the heart of the pandemic? And do you still think there are opportunities for those kinds of transactions in the months ahead?
Yeah, so great question. I mean, I think all of us have a lot of friends that are at, I mean, frankly, you guys are at Time Equities, right? You guys are opportunistic and go after
Yep.
that type of stuff. I think there was a lot of money raised for it. And I remember, I think it was the second day I was sitting at home at end of March when COVID hit, and I started getting phone calls from guys at different debt funds like, what do you have that's non-performing? I'm like, we're 2 days into this, Look, there was a short window when debt funds and private equity funds were having margin and capital calls last, I would say, April and May, to pick up some assets. I was involved in a large $200 million loan sale between Ladder Capital and Madison Realty Capital last April. That was more of a strategic type deal that Madison saw an opportunity. They wanted to buy some loans of a client that two clients that they wanted to refinance, but it was going to take longer to refinance, and these people had maturities coming up with Ladder, and so we were involved with that. The distress none of the banks have been forced to. Abe and I were frankly speaking about this like 15 minutes ago. The banks, none of the auditors or regulators have showed up at the banks since COVID hit, and so there was the CARES Act, which has allowed the banks to offer forbearance agreements. There was PPP, there was EIDL that allowed borrowers to turn some of that money over to their lenders and buy some time with the forbearance agreements. I have seen some distressed hotels trade. One of my colleagues, we just hired him away from Jones Lang LaSalle. He was involved in December. He closed a almost $300 million sub-performing hotel portfolio from US Bank. But for the most part, the rush of non-performing loans and sub-performing loans, though the banks have issues and are there, they're not really trading. I saw something a week ago in a local New York City newspaper thing that we get every day. That's real estate focused, and said there was 18 loans last month, so the month of May, traded in all of New York City. And I think there was like 6 buyers for 18, and 2 of the buyers bought four notes apiece, and it wasn't widely marketed stuff. It was totally off the market between the bank and a favorable friend of theirs that has a debt fund and bought that. I think at some point later this year and next year, they'll start addressing the issues a little bit more, and the loan sale market will pick up, but it has been very, very slow. And that's just not me personally. That's, I'm speaking to other loan sale guys, and everybody's kind of experiencing the same thing.
Right. I mean, I'd kind of go back to what you said on. It really has to do with the asset class, right? Like the hotel, retail, that sort of we saw a lot of those loans go into special servicing. Berkadia is a large special servicer, one of the largest in the country, and the loans that were getting into trouble were the hotel and the retail of the world. And I think there was a lot of capital lined up on the sidelines to take advantage of that, but kind of as Justin said, maybe not as much really transacted as people thought it would. But in terms of the multifamily front, I think that was really somewhat stable. There was eviction moratoriums and whatnot. So, I mean, people really got out of that, and it was, not as catastrophic as people expected.
Right. And it's actually interesting, of the, note sales that Time Equities has acquired. I think all of them, which maybe there have only been, 3 or 4 since COVID, but they've all been for office buildings, which is obviously another strongly affected asset class here. And a lot of it was like newly constructed, where they were getting into their lease up phase, and just obviously were not able to stabilize, with the future still being somewhat uncertain. So I think that.
Yeah, in New York, I mean, we're in the middle of a recapitalization of, it's actually a hotel on Park Avenue. friendly competitive companies out trying to sell the loan right now for the lender. But we just had a term sheet signed for a little over $100 million to recap the hotel and pay off the existing lender. 6 months ago, that wasn't there, that type of money. And that was at, a bridge loan at a 6% rate for a hotel, right? That, has been, obviously New York City hotels, not many people have been traveling to New York, and, it's starting to open up, but, a lot of these guys just need a little bit of time to, for the next year or so for people to start traveling, Broadway to open, and business, travelers to start coming back to New York. And so, things that are distressed are coming back quicker. When I was in LA, one of my clients, he had some issues with his multifamily properties. He's now that people are coming back to LA, from Austin or Montana or wherever they were, hanging out for the past year, he's actually starting to get rents higher than his 2019 numbers, in certain markets of LA. So it's, and a lot of people thought, guys like that were going to have issues and distress, and it's not happening.
Right. Yeah. And I mean, to your comment on the New York City hotel, I'm not sure, not to get too specific, but I mean, there was a recent regulation that is kind of squeezing the supply of hotels in New York, which is probably what is, making that financing obtainable today.
Yeah, we'll see.
Maybe I'll there. But I mean, on the topic of bridge debt, I've certainly, on the owner operator side, been getting a lot more marketing emails to finance with bridge debt. Are you guys seeing a lot more bridge debt transactions done, and are people looking for these kind of loans as well?
Abe, you want to touch on that? Yeah, I mean, I would say the bridge space is super crowded. There's guys that, I mean, are barely breaking even in the bridge space. Personally, Berkadia, we do have a balance sheet. It's tough to compete with some of the extremely aggressive bridge lenders in this space. But I would say it definitely picked up as acquisition activity started to ramp up. While people were uncertain in the market on what COVID was going to do and how that was going to affect properties, right? It just makes more sense for an investor to lever up as high as possible on a bridge deal. I know we've also transitioned from LIBOR to SOFR to talking about a 3% coupon at 83% loan to cost. It just makes sense for an investor on an acquisition to really execute their business plan. So I've seen it, us lose to some bridge lenders on acquisitions recently. They've been extremely competitive. I will put in my one marketing note here that Berkadia did just launch a new bridge fund with Mass Mutual. Justin, keep that in mind as we go forward. So we're now joining the party just because it seems like that's the hot financing product that everyone's looking at right now.
And what I mean on the 3% coupon example you gave, what kind of asset class were you thinking of?
That's really multifamily, right? People going in and buying a Class C, Class B multifamily, changing the countertops from, granite to marble and calling it value add and bumping the rents up $100. That's really what I'm talking about. Just the multi stuff is what I've had the most experience with in the bridge space. But
right.
I'm sure.
So Abe, sorry, go ahead.
Yeah, I mean, we're on the multi side. We're seeing the same thing. We've just closed a couple of single family built for rent communities, which is wildly popular right now. Which basically it's a multifamily play. It's just horizontal instead of vertical, right? But we were quoted and closed in the low to mid threes on a couple of those transactions. I mean, the lower money is all in the anything multi related, right? I just gave the example of a hotel bridge loan. That was LIBOR plus 575. So with a 25 bip floor, that's 6%, right? We're looking at a couple of multifamily deals right now that are coming up on C of O, and this is a topic that you'll probably touch on later, but because of supply chain issues, some of the units have C of O, some don't, and because of appliances not being able to be delivered because there's a lack of that stuff. We're seeing a lot of guys trying to get out of their construction loans because they've had cost overruns because of COVID, and then obviously supply chain issues. And so the bridge market is like it's really busy.
Yeah.
So Abe, you may be a little bit biased to this next question, but it's what asset types do you see your lenders focusing on, or desiring the most as you go to the market, and how do the spreads vary between? We've been talking a lot about multifamily, but if you could kind of comment on, Justin, what you're seeing for office and industrial and retail as well, and hotel.
Yeah, I mean, I would really say it depends what side of the financing business you're on, right? For us, we're just competing mostly in the multi-space, but I see tons of opportunity in other asset classes for groups that do raise equity and debt. So, I mean, I think Justin would probably be able to speak to that better in terms of the full gamut of asset classes.
Yeah, I mean, obviously multi and single family built for rent. You mentioned self-storage. We're doing a refinance of a 12,500 unit self-storage portfolio that's still in lease up. There's probably, and we don't like to go too wide, and but there's probably 13 lenders that put offers in on that. Industrial is super hot. Office, depending on location, and it's definitely like New York, like large cities with high-rise office buildings. They'll scrutinize every single tenant in the building, and what their viability is, and if they're gonna last, if they have what their financial situation, and and what line of business they're in. Act on the tenant side, not just the ownership side.
Right.
So, and then there's probably more money out there for hotels than there has been in the past 4 years, which is kind of interesting. And then on the retail side, I would say grocery anchored is very hot. There's a lot of banks that are super competitive in that space, and obviously every bridge lender wants to, well, not every, but a lot will look at that stuff. But your normal big box malls, that's a whole nother story. But yeah, I mean, look, there's a lot of money out there, and deals are getting financed one way or another. So it's exciting time, actually. Just need to load up on as many deals as possible with good sponsors.
Oh yeah. And so next question, how do you see inflation affecting rates and the sizing on LTV for the mortgages?
I guess I'll take this. I mean, it's interesting, right? There's a huge inflationary print last week, and you're kind of seeing a market correction with rates as of this week. The 10-year yield, the 7-year yield has sort of trickled down from the highs at the beginning of this year. So, right, inflation and rates are, with inflation going up and rates going down, it's not really supposed to necessarily work that way. And why, I don't know. Maybe it's a glitch in the market sort of thing. But I could definitely see as on the acquisition activity across the country, cap rates are sub 5% in markets they had no business being sub 5%. And just these secondary, tertiary markets, you're seeing people buy at 4.5, 5 caps. And what's that doing to interest rates? It's compressing us, right? Because a deal doesn't make sense at 4%. If he's buying at a 4.5 cap, what's the point, right? So I'd say rates are getting compressed, cap rates are compressed, and inflation's going up. So that's kind of what I've been seeing.
Yeah, I mean, I was having a conversation with a client the other day, and they, you know, I haven't seen inflation affect us so much yet. Maybe I just haven't focused on, but I do read CNBC every day, and it's like the topic that I think, owner of every major company is concerned about right now. One thing is, you know, I think real estate will be picking up acquisitions because, you know, somebody was talking about, you know, how you could take the depreciation of an asset and it's kind of like it balances everything out with inflation. So it'll be really interesting to see. I mean, we have two things that are, you know, out there, right? It's inflation and, you know, going back to the supply chain, right? The cost of lumber and the lack of being able to get appliances. I mean, that example that I mentioned about the client. So it's a client in Orlando. They have a 350 unit property, multifamily, it was a hotel that they're converting to multi. They have C of O on 200 units and are 50% leased up. They have another 150 units that they're basically finished, but they need stoves and other appliances. And there's a 6-month backlog of getting that stuff. That's a problem because, you know, they have a construction loan that's still clicking, and you know, we're going in there and we'll, you know, put a, you know, it's a multifamily deal luckily, and we're gonna put some bridge debt on there. But we're seeing that across the board. I had another client in Florida, held off for about 1.5 years on his development, and he came back to me and said, "Hey, I want to see what the debt market looks like for construction for my high-rise building that we'll build." And he sent me a pro forma with sources and uses. I said, "This is the one from 18 months ago. You have to go back to your contractors and go get new bids." And he came back, you know, 3-4 weeks later, and it was $15 million higher than
Still going to build it.
He's thinking about it. He bought the land a long time ago. The land's worth 27 million, and his all-in cost is about 4.5. He goes, it might make more money just selling it right now than actually building it.
I mean, he might be able to, you know, use the land lift to cover the additional construction, but
yeah, that's I mean, that's the other issue I see out there besides, you know, inflation.
Yep.
And so the next question was going to be more so about cap rates and pricing, but it seems like we've kind of touched on this already. But maybe if there is a story that, you know, Abe, you want to share about a transaction you've been working on for COVID, or just in general that you think is, you know, kind of representative of the way the market is turning now. I know we've heard a lot from Justin on specifics, but obviously welcome more stories as well.
I would say the big thing on the multifamily acquisitions, as they started to ramp up, lenders are looking for more real-time financials, right? So we were looking at a transaction in Baltimore of 2 multifamily properties, pretty high-profile seller that I'm pretty sure most people on the call would know, but we'll keep the specifics out of it. But they had a high level of age receivables and delinquent rent, you know, when looking at the transaction, but the asset itself speaks for itself, right? So they were selling it for maybe a 5 cap or so, but with so much late rent outstanding for us, we didn't really know, are we going to go up to 80-85% on the acquisition, knowing that there's all this late rent kind of looming. So I mean, what we kind of had to do was just there is the COVID reserves, obviously, that kind of stabilizes or it kind of adjusts for any risk you're taking with making a new loan. But we were able to go up to full leverage, I think 80% plus 3% for closing costs on that acquisition, and close for them. And I guess really just watch as tenants, you know, on the late rent, billing them and, you know, charging for late fees and whatever you have to do. And as eviction moratorium sort of start to, you know, go away, then I think we'll start to see that delinquency percentages also go down.
Great, thank you, Ed. So I'm going to ask maybe one or two more questions, and then going to look to the audience. And I'm not sure if on other chats you've been asking them out loud, but if people want to start typing in questions into the chat, so once we finish speaking, I'll go into there and start asking some of those from the audience. And then to continue with the conversation for Justin and Abe, do you have any general thoughts on, someone looking to invest in the US market right now? And just very high level thinking about whether, you would recommend that or what areas you would like to focus on.
I'll take the about investing. So I deal with a lot of overseas investors, whether they're in Asia or in the Middle East or in Europe. When I was at Avison, we became a pretty decent sized global company with 126 offices in 17 countries. And so, being in New York, I was doing stuff in LA and Miami. I was fielding a lot of calls and requests from clients overseas. I would say if you're coming in from overseas, don't try to do something on your own. Find a good boots on the ground operating partner that you can put the money with and that can manage and operate. I'm looking at a very large deal right now in Los Angeles that a group out of China came into the United States, did not partner with anybody, and they spend about $1 billion of equity, no debt on the deal, and it's a stalled project right now. And now they've reached out to some local, a very large, reputable U.S. construction company on to kind of handle the construction, and we're softly looking at maybe taking on raising the debt to complete the project. So depending on the location and asset class, I would partner with somebody that is here already in the U.S. And I would also consult with an advisor, a tax attorney, because bringing money from overseas, there's currency risk that you have depending on the country and the U.S. dollar. But U.S. dollar historically has been the most stable, right? And so the U.S. is a great place to invest. So that's just my thoughts.
Yeah, I mean, I would echo that and joining up with a local operating partner and then suggesting on what asset class to invest in. I mean, it's really, I guess it's all about the buy, right? From deal to deal, just kind of bidding at everything at asking price where it is right now. I don't think it makes much sense, just because where we've seen, what we've touched upon a little bit earlier on cap rates, at least on the multifamily space, just trying to, be patient and look back historically where cap rates were versus where they are now and where you're buying it at. Right. I think that's what really makes the most sense.
Right. And where do you think cap rates can go from here? Do you think there's more compression in the future before they maybe start to rise, or what part of the cycle are you thinking that we're in right now? Are we in uncharted waters completely?
If I knew, I'd be a rich man. I wish I knew, but I've just seen them go down and down and down. So we'll see. People have this sentiment in the capital markets world that get it while you can with where they are right now, and everyone's like, oh, they're gonna go up and up and up, and the low 3% money, sub 3% money is gone, and now rates have trickled back down, right? So it's sort of tough to predict. If rates continue to trickle down, then I don't really see much change on cap rates. But let's say rates blow out over the next 3 to 6 months, I think we will see cap rates, start to widen out a little bit.
Right.
I would say keep in mind that the stock market has been really hot as well for the past X amount of years, right? Since and at some point, I would have to think that it's a little bit of a bubble there, and you might want to, if you're an investor, and take some of your chips off the table in the stock market and come back over to the real estate side, just to spread the risk. So I think there's gonna be a lot of money. I'm starting to see it with some older people in their, I don't know if calling somebody old in 60s or 70s, but they're looking to get into just safer cash flowing type asset, whether it's like a triple net lease type deal, 7-Elevens, Walgreens, CVS's, or the single family built for rent, or multifamily, right? Something that has nice cash flow. You can get a manager to kind of manage for you, depending on the amount of units. But keep in mind, people are forgetting about the stock market. I mean, the other thing we have to remind ourselves, but we had a good, I guess, from 2012, we'll call it, to 2020. It was a pretty good 8-year run there, right? And the market on the real estate side was so hot, and everybody was saying it can't keep going up like this. And so I think we were all getting ready for some type of pullback, and then this COVID thing threw us all for a loop. And brought pricing down to, I guess that was the pullback. But it'll be interesting to see. I mean, there's still some good buys out there, but you got to find the right type of asset class and the location.
Great, thank you, Justin. All right, so now I'm going to go through. We got a couple chats coming in with some questions, and just a few in here. So whoever wants to take this, how do you compare bridge versus Freddie float? Maybe they meant bridge versus Freddie loan.
A Freddie floater.
Floater, sorry.
Yeah. So I mean, I can take that one. I would say, right, that the Freddie floater, number one, on an acquisition, you can go up to about 80% plus 3% for closing costs. Comes out to about 82.4% of your purchase price, right? So that's your max leverage on a Freddie floater. On bridge, right, you'll get some lenders with how crowded it is. I'm talking multi here, so when Freddie's obviously only multi, you can get some guys that'll go up 83% of cost, right? So you can get a little bit more leverage on the bridge space, on the bridge loan. But it's a great question in the sense that they're both extremely flexible. On a Freddie floater, you can get that similar leverage type, but you're talking about SOFR plus, on a 10-year loan or 7-year loan, SOFR plus 285, right? So you're paying a 280 coupon, and on a Freddie floater, it's only locked out on the first year, and it's open for prepayment after that. Right, so it's slight give and takes, but then again, dealing with all the bridge lenders there are in the market right now versus Freddie on a floater, your execution, you could kind of think. I mean, personally, I may be biased, but just the certainty of execution on a Freddie floater, you kind of know what you're going in with and what you're going to get, and I'd say less risk of a retrade if you're on a tight timing with an acquisition.
Thank you, Abe. Then for commercial loans, is it 75% or 80%? What is commercial loan interest rate for a 30-year term?
Depends on depends on the asset class. It really depends on the asset class. I mean, as Abe mentioned, on multifamily, you can get up to 80. Between 75 and 80 for, I'm saying an office building or any other type of asset class. More likely it's gonna be a first mortgage somewhere between 65 and 75. 75 maybe if it's like CMBS, but they've kind of dialed back a couple of points. So I would say 65 to 70, and then and again, on a 30-year term, I mean, you could get 30-year amortization.
Yeah.
I mean, most perm deals in commercial are 5, 7, and 10, right? historically, unless it's like a HUD loan where, you know, you're getting, what, Abe, was it 35 years? Something like that.
What's that? HUD loan?
Yeah.
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 Takes about 6-12 months to close.
Yeah.
Great. So if anyone has any more questions, feel free to send them in. And it looks like we're a little bit early on the time, but one other thing that I wanted to talk about that now that we have some time for it, we didn't really touch on at all the pref equity or the mezzanine financing market. And maybe just a quick, 2 or 3 minutes about the activity that has been seen with that type of financing since COVID, and just in general, what the pricing is. This way, we're really rounding things out for everyone on the call today and making sure to touch all aspects of the financing.
Yeah, so, and there's another thing that Abe and I mentioned, or we're discussing earlier. So I'm pretty active. A lot of my deals are structured, and we're raising more than one piece of the capital stack. And so we're very active in a number of pref and mezz deals right now. On the multifamily side, you really can't put mezz, behind a Fannie Freddie. So it's got to be structured as pref, and there's a lot of money out there for multifamily and self-storage. We're about to go out for a pref piece for 20 million on the self-storage side. There's a lot of money for that. And believe it or not, on hotels, I get so many emails and phone calls every week, like, hey, we have money for rescue capital, as they call it, for to come in with some fresh equity, but they want to structure it as pref. They don't want to be an LP. Pricing wise, I would say for multi-pref mezz, it's somewhere between 8 to 11.5%. And that's, a lot of times you can structure it where it's a lower current pay, like a 4 or 5% current pay, and let the rest accrue. And then, going up in the stack and how high you can go, we're doing a construction loan right now, $85 million deal, and we're going up to, so the first mortgage construction lenders, that tops out at 65% loan to cost. And we're going from, we have a pref piece that's only going in from 65 to 85% loan to cost.
Wow.
And there's a lot of money out there for that. We had a number of bidders that were interested in taking that slug. A couple of years ago, you could get up to 90 using pref or mezz. I think, for the most part, 85. We had one deal recently that we were at 86, but somewhere between 80 and 85 is like the higher end where people want to be for a pref or mezz piece.
And what's the spread on that, the deal you were talking about, or ballparking, whatever you can share? Spread as in or the rate, the all in, what are they? Yeah, so good question. So it was interesting. So we went to a couple of banks, right, for construction financing for the first mortgage, and we wanted to see where they kind of topped out. So like we had Bank of the Ozarks and Centennial and guys like that were somewhere between 55 and 60 loan to cost at we'll call it a 4.5% rate. Then a local bank came in at 65% loan to cost at a sub 4% rate, like 3.8%. So it was pretty sick. Then we had a couple of debt funds that came in. So MSD Capital, Michael Dell's family office, real estate arm, they came in and they were going from 0 to 85%, and all in rate, they were around 8%. And then we had a group, Carval, which is a large conglomerate out of Minnesota. They came in and they went from 0 to 85%, and they were like 7.25% rate. And so the route that we're going right now is the bank that's at 65% loan to cost, and then bringing in a 20% piece of
pref from the East Coast pref lender. They're at around 11%. So you blend it together, it ends up being, I don't know. I would have to go back and look the model, but it's like 5.5% to 6% type money. It's pretty good.
Maybe we should chat after this. We're doing a ground up project right now that we're looking for pref on. So we'll connect afterwards. I think we had a couple more questions came in. So let's see what people are wondering. So from Hugo, he says a lot of foreign companies are doing all cash deals in the US because they are having a hard time to apply for the commercial loan. And they are not familiar with the loan industry here in the US. Any suggestions for them?
Yeah, I mean, I just dealt with this on 2 separate clients down in South Florida. They're developers here, based here in the US, but they're originally from Venezuela, both of them, and all their capital comes from Venezuela. And every deal that they've done historically has been all cash. They wanted to explore putting some debt on, and these were multifamily properties, putting some debt on them, and they couldn't get their investors on board. I guess it's a cultural thing, depending on the countries that people are coming from. I mean, is it smart, especially if you're trying to do a lot of deals? I mean, I would say if you want to dip your toe in the water, start at like 40 or 50% leverage, and don't go for 75, 80%, right? Just see how the process works, and they'll see how their returns jump, right? And cash on cash returns jump, and being able to do more deals with more cash, especially once you get it over here, because once it's here, you could hopefully keep it here and keep rolling. But I'm saying just start with lower leverage if you're not used to it. That's my insight there.
Yeah, and I mean, I would add, to get some lenders comfortable, I mean, they'll suggest opening a bank account right with them, or putting some deposits in a U.S. entity. That can get a lot of people comfortable. Or even if in your organizationship structure, creating an LLC with 0.001% ownership interest, right? You're effectively creating a U.S. ownership in that. And while it's really a formality, it doesn't change the structure of your deal. That can actually get a lot of lenders comfortable, just knowing that there is some sort of US based company operating in the ownership structure. So that's how we've gotten some international investors and our credit committee comfortable with international investors.
Yeah, I mean, you guys as a lender, and every lender, you don't want to have to chase somebody if they don't have any money actually parked here other than in the asset, whatever country, good luck trying to find them.
Exactly.
Yeah, people learned that mistake from back in 2008, 2009. So.
Okay, I think that was a really, really insightful answer for everyone. And it seems like we'll do one more question and then we'll be closing out. Why does borrower go for mezz if bridge is so aggressive these days?
I mean, I guess it's an interesting question. I mean, look, there's bridge financing that they call it stretch senior financing, and where it's going, as in the one example that I use, 0 to 85%, right? It becomes a math. I guess you have to run the math and see what it looks like. Does it make more sense going with one bridge lender that's doing the entire stack going up to 80, 85? Or does it make more sense to kind of bifurcate it where you have a bank that's a little bit lower on the first mortgage and lower in rate, and then bring in a little bit higher, but prefer mezz players? So it becomes a math equation at that point in time, and that's on my side, being a broker, if I'm doing my job correctly, I'm giving you multiple different options, and kind of showing it to you and sitting with you and then picking a group that is best fit for you and your project.
Okay, we got one more question came in. Is loan amount based on DSCR or only percentage of appraisal?
That's an Abe question.
That's I mean, it should just be neither, right? Just give me 85% and that's a full-term IO, sub 3%. So it's on every loan, you're testing it two ways, right? You're testing it on value and testing it on coverage. So every deal is either value constrained or coverage constrained. You'll see in the big, markets where cap rates are lower, oftentimes you'll be cash flow constrained, right? Because these values at a 4 cap are so high, the cash flow doesn't support 80% of the value, right? You're constrained at a DSCR of, depending on the lender, it could be 125, 120. The bridge lenders, will go lower to the 1.0s and maybe even lower than that in certain cases. So I mean, it varies on the deal. Every single deal has a constraint to it, whether it be leverage or DSCR. It's really just a model running it. If you're going to be cash flow, also known as DSCR constrained, and then you'll see in an acquisition called in the Southeast or maybe a secondary market, more oftentimes than not, you're going to be value constrained, right? If you're buying a deal in, I don't know, a secondary market of Tennessee and cap rates are 6.5, you're going to be constrained at 80% of the value unless you could somehow get an appraisal that, was supported a higher value, could go up to that. But that would be the answer on that one.
Awesome. Well, guys, I just want to thank you both for taking the time to speak with everyone today, and I hope proved to be an insightful talk for everybody. Just to leave everyone with something for Justin and Abe, gonna ask you guys in 3 words, how would you categorize the US commercial financing market?
Money is cheap.
Could be 3 different words too.
I didn't know if they had to go together or.
Sorry, I should have specified. Didn't prepare you for that one.
Lots of opportunity.
It's good. If it was me, I would say exciting, careful, and I was going to use cautious, but I guess that's basically the same as careful. But anyway, thank you everyone for attending today. And Justin and Abe, it's good speaking with you and meeting you over here. And I'll give it back to the host of the rest of the conference to keep things moving on time.
Thank you, guys.
Thank you.
Hey, Abby, Justin, and Dex, thank you so much. Thanks for the sharing. It's time, so let's just move to the next session directly.
Thank you.
Thank you.